FX Fundamentals Manager Tony Nyman from Informa Global Markets joins me now to discuss some of the latest FX projections for some of the Scandinavian currencies, commodity-linked currencies and the British pound. Tony, I'd like to start by talking about the performance of some of the Scandinavian currencies and perhaps more specifically today, the Norwegian kroner. What are your forecasts looking like for dollar NOK over the coming months and looking slightly further forward?
Well, for dollar NOK we have one and the 3 months at 5.80. In the 6 months, 5.90, and in the 12, 6 figure. We expect a slow grind higher in dollar NOK over the next 12 months. This fits with our overall expectations for the dollar, which we believe will be an outperformer during the period. We're confident in the health of the recovery and see no need for QE3 at this stage, and we expect Operation Twist to run its course. We are actually relatively NOK bulls too. Scandi-wise, a bubbling oil price, Norway's relatively strong fundamentals, as well as a fairly secure AAA status. They're a favourable mix for Norway and the NOK. However, the shock decision of the Norges Bank to cut interest rates in mid-March by 1/4 to 1.5%, and to say after that rates will likely stay there through 2012, compare those to, say, the October forecast, which was a much higher 2.25%. It's a possible game changer. We believe that Governor Olsen moved for one reason and one reason only, and that was to address NOK strength. So for rate differentials purposes, we expect a slight move higher over the period.
What about supposed commodity-linked currencies like the Australian dollar and the New Zealand dollar? They were both undermined by the general waning in risk sentiment following last week's comments by the IMF that commodity exporters may be in for a downturn and, of course, disappointing data out of the US and China. What are your short, mid and long-term projections for the Aussie dollar, Kiwi dollar cross at the moment?
Well, over the period we have 126 for the 1 month, which is pretty close to where we are now. 125 for 3, 124 for the 6, and higher 128 over the 12 months. If you recall, Rowena, when we last spoke in late February, we looked slightly behind the curve when it came to the Aussie, as we were relatively bearish. Despite the very positive, much stronger than expected Australian jobs report this week, it was much firmer than forecasted. Much of the data seen in the last month or so has proved a disappointment, and the RBA is finding itself under increasing pressure to lower interest rates from the current 4.25%. Further, China hard landing speculation increases all the time, and there has been articles in the local Australian press suggesting that the domestic investment boom we've seen over the last couple of years, linked to your commodities, has peaked. Therefore, we're happy to stick with our return to sub-parity levels in the Aussie estimate, as well as a further light drift lower in the Aussie-Kiwi cross. Recently, the New Zealand data is generally in a more upbeat trend than its neighbour. But, and this is one of the reasons why we don't expect a bigger decline towards the 120 area, we're sceptical that Aussie Kiwi is in for a bigger fall. Again, lower for now in Aussie Kiwi, but we expect it to go back up further out the curve.
Euro pound is still close to its January lows. What's your short and longer term outlook for this pair? Are you quite bearish?
Euro sterling we have at 83, 1 month, 82, 3 month, 80 in the 6 and 77 in the 12 months. So we're relatively bearish, and we expect a fairly consistent decline in euro sterling in the coming months. They're both relatively ugly currencies right now, but they're actually showing fair resilience. But we think there are just more risks associated with the euro still, even through the LTROs, the bailouts of Greece, and the proposed increased firepower of ESM, EFSF firewalls. The bad news for the EMU keeps on coming. Spain in particular, Portugal and Italy, they're taking it in turns to come under the microscope. Meanwhile, all this mega austerity that's going through in the peripherals in the EMU means no growth ahead for many of those EZ countries. So we think sterling will continue to be a beneficiary of the ongoing EMU debt crisis. Overall, we're not sterling bulls, apart from against the euro. We think UK recession and AAA status worries will cause sterling underperformance ahead, but that will be likely reflected more in markets such as the dollar, the yen and the Swiss ahead.
Thank you very much, Tony. A pleasure as always speaking to you. I'm afraid that's all for Targets in Focus this week, but there'll be plenty in store next week on Dukascopy TV. Goodbye for now.